On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So, before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Hi, team. Just wanted to jump on here and share a few thoughts about how markets are tracking at the moment. Because after a very strong first 7 months of this year, August is proving to be much more challenging for investors. So we have got a bout of August anxiety that seems to be gripping financial markets. So let's dive into that. US shares this month are down about 4%, which is a pretty hefty fall. And we've still got, I think, 7 trading sessions to go in the US. It's Wednesday, the 23rd, as I record this. So the numbers will change. But as it stands today, the US market, and I'm looking at the S&P 500, down a little more than 4%. So that sees August on track to be the worst month since December last year. So it's been a while since we've had a month where the share market was as weak as this. And while I'm talking specifically about the US, we have seen that weakness reverberate around the world. So here in New Zealand, the NZX 50 has been off the boil, and we've seen the same across the Tasman or in the UK or in Europe, I should say. All markets are interconnected, so you do tend to see them all move in a similar pattern. Not always, but quite often. And with the US market being the biggest economy in the world, the biggest share market by some margin, and to be frank, the most important share market for most investors, they do set the tone. So, been a difficult month. Should we be surprised? Well, in some ways, I don't think so. August is typically one of the weaker months of the year for US shares. And if you look back to 1945, and you can find these stats on our website, talk to your advisor if you want to get a hold of the report that I've written with the charts. Going back to 1945, August is one of the weaker months of the year. It's not the worst. The worst is actually next month, September. We'll talk about that in a minute. February's typically a tough one, so is June, and then comes August. So it's in that sort of bottom half when you look at the typical seasonal patterns for each month of the year. And I guess one reason that might be is because over in the US, July, August, that is the summer. So you've got a lot of investors that are away. And for whatever reason, at that tail end of summer, sort of around that August, September period, you often do see lower volumes, less trading, less liquidity. And what that can mean is that sometimes market nervousness or negative news flow, some of those technical factors that you often see, all of those things can sometimes mean that markets will fall more than usual because you just haven't got as many people around. So for whatever reason, August is a fairly difficult month. We've also had a very good run. So look, before we get hung up on the fact that, well, this month's been a bit difficult, we're down sort of 3, 4, 5%. Let's remember that share markets have had a pretty stunning run over the last 9, 10, 11 months. The S&P 500 in the US bottomed out in mid-October last year, and between then and the end of July, it rallied 28.3%. So that is a pretty stunning rally from mid-October through to the end of July. And we can't ignore that. Share markets don't move in a steady grind upwards. They're not that sort of asset class. They will move upwards over the long term, but from week to week, month to month, even year to year, you will see periods of strength and then sort of pullbacks and then periods of strength and so on and so on. So it's not something to be hugely surprised by. August typically is a weak month, and especially when you're coming on the back of a very, very strong run. However, seasonality is not the only culprit. It's not just the fact that this time of the year is often weak. There's always unique things going on across financial markets, and every August is different. So some of them are going to be strong, some of them are going to be weak, and all the variability across the spectrum. But at the moment, some of the things that markets are watching closely, and I think some of the things that are feeding into the volatility, rising bond yields is a big one. So the yield on a 10-year US Treasury bond, a US government bond, has been climbing steadily since late July. Bond yields were sort of in a bit of a holding pattern, a bit of a trading range leading up to the start of August. But since late July, there's been a noticeable rise in bond yields, and we've seen them rise from the high threes, 3.9, 3.95, and they've pushed up to a little above 4.3%, which is actually quite a lot. And that's notable because US 10-year Treasury bond yields have actually hit the highest levels we've seen since 2007, just in recent days. They pushed above that 4.34% sort of level, which is something we haven't seen for 16 years. So it is getting a lot of attention out there in the market. We've seen similar increases in bond yields in Europe and in Japan, not obviously to the same degree in terms of yields rising to that same sort of 4% plus level. But from where they were, we've seen them pushing higher. And it's quite interesting because we haven't seen that happen because of inflation rising. Recent inflation readings have actually been in line with expectations. The last US monthly CPI came in at, I think it was 3.3 off the top of my head annually, which was pretty much where we were expecting it to be. It's down from 9% middle of last year. So inflation's been behaving itself in the sense that we haven't seen any major surprises with inflation being more than expected. Even in places like the UK, where you've got very high inflation, their inflation rates have come in pretty much in line with expectations. So inflation has been as we expected it to be, and longer run inflation expectations, which are also important, and they're a driver of what you see in terms of bond yields and interest rates. Those longer run inflation expectations haven't risen either through the month of August. In fact, they've slipped a little bit. So you can't pin the blame on inflation. Could be a couple of things. It could have been that decision in late July from the Bank of Japan to lift its cap on Japanese government bond yields. That was quite a notable change of policy from the Bank of Japan, and that was one of the last sort of anchors that were keeping global bond yields low being lifted. Even though that's happened in Japan, it does sort of filter through to other markets because investors and the people buying and selling bonds, they play in all those markets, and it's all about the relativities. So I suspect that was one factor. The Fitch downgrade of the US credit rating that came around the same time, that might have also contributed. And I know what you're thinking. Well, that really wasn't a big deal, Mark. There's nothing to see here with that Fitch downgrade. It's kind of a bit of a non-story. Look, fair point, but it did come at an unusual time because it came at a time of lower than usual liquidity across bond markets. It might have had a more significant impact than it otherwise would have. So, maybe those things are factors. I think the optimists out there probably would point to the fact that higher bond yields aren't a terrible thing. They might suggest that markets are becoming more optimistic about the economic outlook. If people are very negative and despondent about what's on the horizon, what do they buy? They buy longer term government bonds and treasury bonds because they think there is there is carnage ahead. There will be economic weakness. There will be share market weakness. Central banks will have to cut rates. Growth will slow. Unemployment will rise. When you're nervous, you buy bonds, particularly government bonds. So that sort of environment and market sentiment tends to push those longer term interest rates down. And when you've got those interest rates going up, that is not a sign of people getting particularly nervous about what's on the horizon. So maybe that's a factor. A lot of talk about out there at the moment about where the sort of neutral rate is for some of these central bank policy settings. The neutral rate is, of course, the level where a central bank is um, not stimulating the economy, but also not holding it back or slowing it down. So it's sort of the level, the steady state level. And some people believe that because economies are in better shape than people think, and they're more resilient than people think to higher interest rates, there's a lot of people that would say the neutral rate, that steady state break even level, is actually higher than we've thought it was, and that's why you're not seeing the wheels fall off. Even when you've got an OCR in New Zealand of 5.5%, or in the US of also 5.5%. So maybe that's a factor, but either way, probably a combination of all of those things. To be honest, either way, bond investors are being left with more yield after inflation, because you've got those nominal bond yields rising. On the face of it, you're seeing those bond yields rise. Inflation expectations haven't moved, so the after inflation return that those bond investors are getting is going up. So the real return is higher, which isn't a bad thing. And if you want to know more about real returns versus nominal returns, wrote a piece on this a few months back now, but it was fairly timeless, and it will still be a good educational piece, and recorded an episode on real and nominal interest rates. So go and dig that out if you want to know more about that sort of concept. It's a really important one, actually. But with those bond yields going up, inflation expectations relatively stable, real returns have increased, which on the one hand is great for prospective bond investors, because they can get better value, they can get better opportunities, but it's also a headwind for shares, because the more appealing and attractive conservative assets like bonds look, if you can get a better real return on a treasury bond than you could a month ago, well, that is going to be a handbrake for the share market, isn't it? Because the main alternative to putting your money in shares is to put it into bonds and get that sort of much more predictable, stable income stream with a lot less capital volatility. And if that sort of asset, that risk-free asset, is looking better value and more appealing, then you're probably going to be less inclined at the margin to put your money into the share market, or you're going to expect a better return from the share market accordingly, which means the price has to adjust to reflect that higher expectation of returns. So I think that's a really important factor. Maybe that has been part of the reason we've seen weak share markets. And it's not all bad. It's good and bad. Then you got China. The China situation definitely adding to the nervous sentiment. We all expected the world's second largest economy. The US is the biggest. China's number two. Expected China to rebound from last year's very strict COVID-19 restrictions. They were relaxed at the end of last year, start of this year. We expected a big snapback. Hasn't really happened. Haven't seen that materialize. So China's been a real disappointment this year. Consumer spending has been weak. Domestic demand has been weak. I think a big difference is that when Western countries stimulated their economies through the COVID period, they did that by giving consumers and households money, right? So you ended up with consumers and households that had excess savings, and when things did reopen, they went out and spent those savings, and you're still seeing that happen as we speak. You're still seeing the lingering effects of those excess savings because of all that COVID stimulus. Now, China took a different approach. They stimulated in other ways. It was more around sort of infrastructure and investment. So you haven't got Chinese households that have been left with a bit of extra cash to spend now that things have opened up. So you haven't seen that snapback. You've also got the real estate sector looking increasingly fragile. It's not pretty what you're seeing over there in the property market. And you've got China that's grappling with fears of deflation. The rest of us are all uh, we've got an inflation problem. Prices are rising too much, more than we would like. We want the pace of price increases to be much lower. In China, it's the opposite problem. Prices are not rising enough. So neither of those things are fantastic, but it's just notable that they are dealing with some quite different issues to other parts of the world. So I think that is generally weighing on sentiment as well. What does it all mean? Where will markets go? Well, impossible to say, always impossible to say. And I wouldn't be sitting here talking to all of you if my crystal ball worked well enough to make these predictions with accuracy. I think that goes without saying. But recent trends could continue over the near term. And the reason I say that is I talked at the beginning about August being quite a difficult month for markets. Well, September's even worse. Not only is it a tougher month than August, but it's actually the worst month of all for US shares. And in those 78 odd years since 1945, so looking back over the last 8 decades, if you look at all the monthly returns for each of the 12 months on average, the average return for September has been minus 0.5%. So it's been a tough month. That's the lowest by some margin. The second worst month is February, and it's only minus 0.1. So there's a big difference between minus 0.1 and minus 0.5. For what it's worth, the average monthly return over all of those months is 0.7, up 0.7. So most of the time, each month, US shares up 0.7%. Times that by 12, and you get sort of roughly 8.5%. Add a couple of percent of dividend yield, and then voila, there's your 10% per annum long-term return, which is roughly what the US market's given you. But September's absolutely bottom of the pack, and it's also the only month of the year where the share market has fallen more often than it's increased. So you take those 78 years, and I think there's been 78 since then. So of those 78 Septembers, more than half of those have seen the market fall. It's only up sort of 44% of the time in September, and every other month has a hit rate of north of 50, and the average of all of them is about 60%. So 6 out of 10 times in any given month, the market be up, but not September for whatever reason. It's just a difficult one. So who knows whether those seasonal patterns will continue this year. That's sort of an average, but every year is different. There's always something else going on. There's always a different backdrop. So take that with a grain of salt. I just think it's sort of interesting to note. More encouragingly, November and December are typically the most lucrative months of the year. November is number one, strongest month of the year, average return of 1.7%, up 68% of the time. December is a close second, average return of 1.5%, up 75% of the time. And October is not a bad month either. That's a month where you generally get pretty solid returns. So if the typical seasonal patterns are to follow that trend, then we're in the midst of a pretty difficult month now, being August. September could be a little bit volatile, who knows? But just be aware. However, October, November, December tend to be a very good period for the US share market. So if the US economy can hold it together, if inflation keeps trending lower, and if central banks don't have to do any more than they're already expected to, it's all about expectations, remember. In New Zealand, we think the Reserve Bank is pretty close to done. I personally think they're done. In the US, similar story. Couple of places, there's maybe another rate hike or two to come. Europe, the UK, but we know that that's expected. So it's not going to be a surprise to anyone because we're already expecting it and we've factored it into our thinking and we've factored it into share prices, interest rates, and currencies. So if things play out as expected and the economy holds it together and inflation keeps playing ball, you might see that seasonal pattern hold true. You might see this current, pullback, breather, whatever you want to call it, last for a little bit longer, but you might see a more positive, more optimistic end to the year. And if that's the case, then this current period, even though we're in the thick of the worst month since last year, markets are still in generally good shape relative to where they were at the beginning of the year, certainly in the US. And if those seasonal patterns hold true, then maybe this period will simply be a pothole in what is an otherwise rewarding year for investors. So there's a bit of food for thought. As always, if you want to know more about anything under the sun, we have loads of research. Get in touch with one of our advisors. If you're listening to this for the first time, then there is a back catalogue of other episodes on some really interesting topics that are still very relevant to the current investment landscape. So take a look. Thanks for listening, and we'll talk again soon.
For more insights, visit craigsip.com.